We were actually kind of having a nice week until Friday rolled around. We were down 37 basis points real early in the morning. It looks like it was wise for the bond market to play it safe by winding down the rally momentum yesterday because the jobs report doesn't line up with the weakness seen in the balance of the week's economic data. Bonds sold off accordingly, but fairly modestly in the bigger picture of things. U.S. payroll growth moderated in March, while wages advanced and the unemployment rate retreated, sending mixed signals to the Federal Reserve as it debates how much higher interest rates will go. Non-farm payrolls came out at 236,000 versus a 239,000 forecast, which is pretty close. It was 326,000 last time, which was revised down 17,000. Unemployment rate came in at 3.5 versus 3.6 forecast, 3.6 previously. It's weird that you can have such drastic changes and it stays the same. That unemployment rate almost seems fishy. Earnings came in at zero point 0.3 on a zero point 0.3 forecast, zero point 0.2 previously. Atlanta Fed's GDP now has declined sharply over the last few weeks, with the index now seeing 1.5% growth in Q1. Index was at 3.5 just a few weeks ago. Looks like the ISM reports, along with the weaker consumption numbers, pulled down the index. Not so much the banking news. Overall report was more or less in line with expectations. The labor force participation rate and employment to population ratio rose, which shows that more workers are re-entering the labor force. Average hours worked was amongst the lowest in quite a while, so employers seem to be cutting hours, not jobs. The market is pricing about 14 basis points of May tightening in the lead up to the jobs report, suggesting a little over a 1 in 2 chance of a hike. The other day we were down 48 basis points at 100.75, which is putting us right around that thick black Fibonacci line right in the middle of all of the converging lines. So we have a whole lot of different factors converging upon each other. Also got a big shocker of news. It wasn't a total shocker. There was a lot of rumors of it coming up, but shrinking wholesale lender Home Point is closing its mortgage origination business and will sell its origination-focused assets to competitor The Loan Store, the company announced on Friday. Turning from its primary market to the capital markets, investors continue to sit on the sidelines of the $11 trillion mortgage-backed securities market as they await BlackRock helping the Federal Deposit Insurance Company liquidate roughly $100 billion MBS portfolio it acquired from Silicon Valley Bank and Signature Bank. Those banks will probably be mired down in lawsuits for years, but that's going to be a lot of MSRs hitting the marketplace. Next week, we got some big data. We get the CPI number on Wednesday. All eyes will be on that. 3-year note auction on Tuesday, which might have a little bit of a foretelling thing. We also get a 10-year note auction and the Fed budget on Wednesday, so Wednesday's going to be a real big day. Thursday we get producer prices and core producer prices and a 30-year bond auction. And then on Friday, retail sales. So a lot of data coming next week, so get a little bit of rest this weekend and check out our common sources and influences, particularly our sponsor at WellThatMakesSense.com. Have a great weekend.